Question 27. To solve this question, first, let's prepare the allocation schedule of a subsidiary acquisition date fair value. Okay, so this is the schedule I prepared already. And first is to get the fair value of the 90% controlling interest. Next, we can get 10%, the fair value of the 10% non-controlling interest. Both numbers are given in the question, and add them together, we can get the total fair value in this acquisition. It equals to 380,000. And the total book value acquired, or the book value of the subsidiary, is 326,000. The number is given as well. And next, we can get the excess fair value over book value amount. It equals to 54,000. And then we allocate this 54,000 to those subsidiary accounts that have different fair value from book value. The first one is building. It is undervalued by 18,000, have 9-year remaining life, which means that every year there is going to be a 2,000 excess depreciation. And second one is patent. It's undervalued by 36,000. It has 6-year remaining life. So we know that each year there is going to be a 6,000 annual amortization expense. So in total, that is $8,000 per year. Alright, then let's go ahead to answer those questions. Question A. What was the annual amortization resulting from the acquisition date fair value allocations? The number is 8,000. We just calculate that number with our schedule. Second one, were the intra-entity transfer upstream or downstream? Okay, so the intra-entity transfer here is the inventory transfer, and the seller is a subsidiary and buyer is the parent. So it's upstream transfer from subsidiary to parent. Okay, question C. What intra-entity gross profit in inventory existed as of January 1st, 2018? Or in other words, what is intra-entity gross profit in inventory at the end of 2017? So at the end of 2017, we use entry G to defer those those gross profit in unsold inventory. And so journal entry is debit cost of goods sold and credit inventory, right? And so we get those deferred amount is using the gross profit margin 40%. So 40% is calculated by using the selling price minus the cost and divided by the total selling price. We get 40% and times the balance of the remaining inventory, and then we get 15,000. So 15,000 is the intra-entity gross profit in inventory exists as of December 31st of 2017, and also the beginning of 2018's existing deferred gross profit. Okay, question D. What intra-entity gross profit in inventory exists as of the end of 2018? So this question kind of asking for the entry G for 2018. Well, still same journal, same account, debit cost of goods sold, credit inventory, but here to get the amount we need to use the 2018's unsold inventory and times 2018's gross profit margin, 42%. Still, we're to get the gross profit margin, we also need to use the selling transfer price minus the cost and divided by the total transfer price, which is 42%. And the total amount of intra-entity gross profit in inventory is 21,000. Alright, so that's the answer for question D. Question E. What amounts make up the 68,400 equity earnings of Bray account balance for 2018? So this question kind of asking for the investment income from Bray, and to get investment income, and first we know that 80,000 is the reported income, but we cannot use that directly because the parent is using equity method, so we need to make some adjustment. The first is that we need to minus the excess annual amortization expense, 8,000. Okay, that's 8,000 here. And second is to plus, we plus 18,000, so the plus 15,000. So this 15,000 is the recognition of the deferred gross profit in the inventory as of the end of last year, and then minus this year's deferred inventory, deferred gross profit in the inventory, and then finally times 90% because controlling interest only have 90% of the subsidiary company. Okay, next question. What is a net income attributable to the non-controlling interest? Well, in prior question, we get the investing income for the controlling interest with times 90%. So what we're going to do here is just change the 90% to 10%, and we'll get 7,600. It's going to be the net income attributable to the non-controlling interest. Question G. What amount make up the 450,000 investment in Bray account balance as of December 31st, 2018? Okay, so 450,000 is the annual balance of investment account at the end of 2018. And normally the way we update this investment account is to use beginning balance and plus any net income reported by Bray and minus dividend paid by Bray, and also need to adjust for the excess annual amortization, and then also minus any other expenses related to those intra-entity activities if the subsidiary is the seller. In other words, if it's upstream transfer, then we need to consider those gain or loss or those unrecognized gross profits as part of those adjustments we need to take care of. So for this question, the beginning balance of the investment account is 340,000. That's the balance at the beginning of 2016, and then we plus all the Bray's reported net income over the 3 years. Okay, so from 2016 to 2018, we have all the reported net income from Bray, and also we know that Bray pays dividend every year. We need to minus the dividend as well, and also we need to adjust for the 3-year excess annual amortization. Okay, so far it's going to be the same as what we did in prior chapters. Well, in this chapter, there's some more adjustment is related to this 2018's entry G, the deferred gross profit. Really, because the Bray as a subsidiary is the seller in this transaction, in this intra-entity transaction. So we need to, because there are some inventory not sold out yet, so we need to deduct that amount from the net income of Bray. So we need to minus 21,000 as well. So that's in entry G. So after we calculate all those changes related to investment account, we need to time 90% because the parent only get 90% of controlling interest. So times 90%, and then we can get annual balance for the investment account of 450,000. Alright, so let's move on to next question. Question H. Prepare the 2018 worksheet to eliminate the subsidiary beginning owner's equity balance. So that's actually the entry S we need to prepare. So in entry S, we debit the subsidiary equity account. It includes common stock and retained earnings, and we credit investment in subsidiary and credit non-controlling interest. Okay, and we know that common stock balance is 150, and then what is retained earnings balance? So at beginning of year, retained earnings balance is 278,000, but also because there's a star G, we need to prepare before this entry. So in entry star G is to recognize the deferred gross profit from last year. This entry we debit retained earnings. of 15,000, and this return earnings actually the subsidiary's return earning or seller's return earning, because the sellers, because this is upstream transfer, so this is actually the return earnings of Bray. And the debit return earning means that we are going to reduce the balance of subsidiary's return earning by 15,000. That's why we minus 15,000 from the original the unadjusted beginning balance will get 263,000. Alright, so that's the two equity account, and then we're going to allocate 90% of the total debit to investment account and allocate 10% to the non-controlling interest. Alright, so that's that. What country we need to prepare.